What's up, opportunity cost investors? Welcome to the fourth ever episode of the Opportunity Cost Investing Challenge. And in this episode, we're going to recap the previous three episodes. I'm going to expand the concepts and talk about it in an easier to understand way. And then I'm going to discuss things that I'm really excited for the future of this journey. And before we begin, here's a sponsored product. No, I'm just kidding. Instead, I just want to talk to you about the description. Moving forward, I'm going to put a lot more effort into the description. As it is now, I try to do like a time-stamped synopsis or like a too long didn't watch kind of version of the video. But I also include like resources and corrections or anything that I forgot to say or want to expand on after I've already made the video. So I highly recommend you check out the description in each of these portfolio journeys. The first portfolio update we did was the purpose of it. And that is a stock journey to teach people how to do stock journeys. And you don't have to do it on YouTube or anything like that. More of a way for us to discuss how to calculate and communicate your performance so that way you can find out if what you're doing is effective or not. So to do this, I decided the best way I can do this was to put $1,000 into a Robinhood stock account and walk you through how I calculate and communicate my performance as I make contributions and as I go through time, and what not to do, because I feel like the both are equally important. But my biggest hope is that I'll beat the S&P 500 and build a reputation, and people understand the value of what I'm trying to present, calculating and communicating the performance. That's the purpose. My biggest fear is that I don't beat the S&P 500 and people don't pay attention to the value I'm trying to create, even though they're not synonymous with one another. My other fear is that even though I tell people I'm almost definitively, and we'll just say definitively for argument's sake, beating the S&P 500 index, that it's watered down from people who think that they are, but they're not. And I could cough into my hand and probably say a couple names, but I won't diss anybody here. That's not my intentions. But that's it. The first update was the purpose, a stock journey to teach people how to do stock journeys. So on the second journey, I talked about average cost per share, a metric that some people use to tell you about their performance. And I told you how I think it's meaningless. So I'll explain it a little better here. Imagine I were to give you an offer. If you give me $50, I'll give you $100. Do you take the offer? You should probably ask when you're getting the $100. So that $50 gain, the dollar amount, doesn't matter to you. What matters to you is a percentage that takes time into consideration. Because if I were to give you the $100 in a year or 100 years, it would make a huge difference, right? Average cost per share is a lot like saying yes to the offer without understanding when you're going to get it. So a lot of people like it because if you were to take the average cost per share and the share price today and subtract it, you would get the dollar amount that you gained. But the dollar amount doesn't make a difference to us. It doesn't tell us about your performance, just like in the example I gave. What you would need is a percentage that takes the time metric and the time component and the money weighting component into consideration. That's reason one. I would not use average cost per share. All right, so reason number two, and this one gets pretty complicated, but I think I finally got it after 30 or 40 takes by now. Would you rather know the price of a company or the intrinsic value? Personally, I want to know the intrinsic value. So let's pretend we had a company, ABC, selling for $100 on January 1st, 2021. 1 year goes by, nothing changes with the price of the company, and it's still selling for $100 January 1st, 2022. The intrinsic value of the company could change significantly in a year. And if you don't believe me, just look at Tesla, for example. And it doesn't have to be 1 year, it can be 2 years, 3 years, 1 day, 1 week. Doesn't matter. What you're looking at only is the price. And because average cost per share doesn't give you when it was purchased, you can't get a sense of that intrinsic value. On top of the fact that I discussed as the first reason is the time consideration. And to add to the time factor, you can't even look at taxes. And that's because you need to know when contributions were made to discover whether dividends were qualified or unqualified, or capital gains were short-term or long-term, an example like that. There is actually a time you can use average cost per share, but in practice it's rarely ever found, and I don't want to overcomplicate something. So to sum up average cost per share, you can't use it because it doesn't take time into consideration. What I would use instead is the transaction history. Because if you can look to see when you purchased it at certain times, I think that's more valuable to you than seeing the average, because the intrinsic value at those certain times can be seen, whereas average cost per share kind of masks it. And then there's the intrinsic value. For all those reasons, I would not use average cost per share. On the third portfolio update, we talked about a concept called asset allocation. So let's pretend you had an M1 finance account, a bank account, retirement, a house, Pokemon cards, other collectibles. Each one of those I would call portfolios. And the sum of all of it, your asset allocation. It's how you move money between each of the portfolios. Now let's pretend you were given $100 to invest any way you want to. Statistically, most of us would be best off putting it into an index fund as soon as you possibly could without giving it a second thought. However, most of us succumb to our innate human biases and think we can do something better. Alright, so now let's pretend you wanted to take that $100 and instead of put it in the index, do something else with it. There's probably an infinite ways you can split up that $100. But if you wanted to determine if you were better off spending the $100 in the index or doing what you're doing, which I definitely think you should to align yourself with your best interest, then you would want to follow the complete $100. It doesn't matter whether you broke it up into 80% stocks and 20% cash or 70% stocks and 30% Bitcoin. As long as you follow the whole 100%, you can make a comparison. I could have done this, the index, or this, whatever else I did. So let's pretend you had an investor who decided they wanted to do $90 in stocks and $10 in cash. Even still, you can break it up into a lot of different scenarios. That $10 in cash could have been kept in the brokerage with the stocks, or it could have kept outside with a bank account. As long as you follow the whole $100, you can make that comparison. $100 in the index or 90 in stocks, 10 in cash, however you want to measure it. However, there are some times where you can ignore portions of that $100, and then it would be a different percentage here and a different percentage here. And that might have confused you. Let's pretend someone took the $100 and said, I'm going to take 10 of this and just gamble it. Don't look at it in terms of my performance. Just look at it as I blew it as fun money. Well then, yeah, you would want to compare it $90 in the index versus $90 doing whatever else you want to do. But that's where it comes down to like seeing performances as an art, and it's up to the analyst's discretion and is up to your interpretation. So it's not an exact science. And this is where, as the person who's providing the performance, I'm going to give you every single detail you can so you can make the definitive answer. Where I say it's gambling and you say, well, actually, I think it's more like performance. You can make that decision for yourself. But that only happens, and everything else I talked about, when you get the full picture, the whole asset allocation. So that concludes the recap of the previous 3 episodes. And of course, if I didn't clarify anything or I didn't expand on the concepts enough, leave a question in the comments below and I'll address them there, or I'll make future videos. I don't care if I have to do 5 or 6 videos on the same topic, trying to explain it different ways, as long as it gets through. We want to build that fundamental basis first. So with that, I think it's actually a great time to jump into the Robinhood stock portfolio. Here it is. Okay, so on an after-tax basis, we made an annualized 123.91% return, which you can find in the Excel sheet linked below. You won't find that return anywhere on this screen. And that's because, like I've talked about before, Robinhood doesn't give you your actual return in the vast majority of cases. Now, how did we compare to the S&P 500? We're still outperforming. The S&P 500 on a pre-tax basis made 59.16% annualized, which is huge, which means we're like double in the S&P 500, which is amazing. Not only because we're outperforming, but because it helps build that reputation and say, hey, he's got something to add. And it's the value of calculating and communicating performances like we talked about earlier. But anyway, here's the portfolio. You might notice that the ending balance here is going to be slightly different than the Excel sheet. And that's because I did the Excel sheet this morning when the market was still fluctuating. I just picked a balance at whatever time it was. It was probably around here somewhere. But yeah. You'll also find that the ending balance will be different because I exclude the free stock Hecla mining. This is another cool thing where I'm teaching people calculating and communicating performances. And one thing I do on this journey is I exclude the free stocks, not only because in case someone wanted to, now they have the ability and understanding to do it, but also because as an opportunity cost investor, anytime a free stock enters my brokerage, I want to be like, is it going to be worth more money and more performance, I should say, to sell this and move it somewhere else, or should I keep it there? And I'd have to do an analysis on every security, or I'd have to just blanket sell everything and put it into the index fund. And I don't want to do that kind of work anyway, so I'm just going to ignore the free stocks. But anyway, Hecla Mining, I actually got a dividend from them too, so that was kind of cool. So it's at $6.04 it's actually doing pretty good. For a free stock, I'll take it, right? Bank of America takes up number one part of my portfolio at around 66%. So about 2/3 of my portfolio is Bank of America. And I actually approached the 100 shares mark, which is pretty cool. I've only done that a couple of times. And being that Bank of America is so low in the price, so it's $30, it was much easier than some of the other companies I've invested in, like Berkshire Hathaway, for example. But yeah, I could scroll down to the history, but my cost basis is in the Excel sheet, which is linked in the description. But I feel like a lot of people like seeing it in this way. So Bank of America, Ally Financial, I didn't actually buy anything this month. I bought $200 worth of Bank of America this month and $800 worth of the S&P 500 index, which I'll talk about in a second. So Ally Bank's about 8% of my portfolio, 10 shares. Pershing Square Tontine Holdings, I didn't add anything to it. Honestly, it's outside my realm of confidence. I understand the concept, but I've never done anything like it before, so I don't think I'll be adding anything. Even though I feel like there's huge potential, I'm just not confident investing in this type of security. And I have 9 shares in it because of the way that it's written into the contract, which I can talk about in other times, but Downey at Wolves Investing has already done an amazing job. And you can find a lot of resources online too that'll help you. But right now it's at 5%, and I don't plan on adding anything to it. Then we have the S&P 500 index, which makes up about 20% of my portfolio and 2 3/4 shares. The reason why I have so much in the S&P 500 index, which almost seems like a cop-out because I'm trying to outperform the S&P 500, is because this is my cash fund. I don't like holding cash because there's an opportunity cost tied to it. So if you see this VOO, you should see it as my stockpile until I find an opportunity, and then I'm going to brush it all over. Or I might look at the stocks I have and try to figure out what allocation should go where. But essentially, this is my opportunity hunting. I did put $200 in Bank of America, so I still think there's a lot of value that can be gained from holding the security and by adding to it. But I did start to purchase less of it because more of the intrinsic value has been realized up until this point. So I'm still pretty bullish on Bank of America. I still think it's got a way to go, but I won't be adding too much to it as we go on further unless things change, right? But that's pretty much it for the portfolio. I think I don't have any more securities, right? So if I go back real quick, yep, that's it. Just these 4 securities, really. That's all I have for this video. In the end, I like doing shout outs. This one goes to a bunch of people. It is Fire from Me, Growing Financially, Alex Peroff, Jamie Jagger, and a non-YouTuber, MP, who have been reaching out to me and asking questions in the comment section, and is part of the reason why I wanted to do this, so that I can provide better quality of the material I've already made. So shout out to everybody there. But that's all I have for you in this video. If you found the content helpful, make sure you like that smash button by stalking our subscribe account and Liberty Bell, that notification icon. Thanks for watching, and until next time.